Okay, ladies and gentlemen, in this quick video, I'm going to show you two bond trades. Now, if you are considering trading for a living, we believe that trading bonds is not only the most professional way of one of the most professional ways of trading. I'll just keep it simple. You'd be crazy not to consider trading bonds because the relationship, if you're trading pairs, the relationship is fixed. Right? It's innate. It's inherently part of interest rates. All right, so what did we do here? Let's keep it simple. See the yield curve? Some of it's steepening, some of it's flattening, but on the 5 and 30, it looks like the curve could be rising, right? So if interest rates go higher, bond prices will fall on the long end. Remember that. And then we go over here to the bond desk and we say, geez, what's expensive? Well, the ZB is expensive relative to the ZF. It's actually the lowest in the entire bond complex. The ZB isn't necessarily the highest because I didn't include UB in here, only because UB is the true 30-year is just not as liquid as these. And when you're trading spreads, when you're trading anything, liquidity should definitely be an important factor for whatever you decide to trade. So these are among the most liquid assets on the planet, all right, especially this SR3. What do we have here? We have the ZB and the ZF. We went over here on the yield curve. We said, yep, still steepening. Okay, which means if it steepens this, yield should go higher, bond prices should go lower. Remember that. And then I looked at the outright and I said, geez, what's expensive? Let's take a look. Same thing. This is the bond desk. Pardon that. Okay, these are standard deviations. This is the actual outright P&L. So let's take a look at this. If I had traded the ZB, I'm already up $1,094. The ZF is down 117. These are way out of balance, guys. This is way out of equilibrium. And then look what happens over here when they're too far out of balance. They always come back home, right? They always come back into equilibrium. There's a natural order. The same reason if you were to lend somebody money and they said, I'll pay you back in 6 months, you're going to charge a lower interest rate. But if they need 10 years to pay you back, they're going to charge you a higher interest rate, and there's more risk to it. And I'll get into that and really dig into depth about the interest rate market and how to view it and how to trade it. I'm kind of fast forwarding it. I'm saying this is how you trade it. Some of you might not care about the fundamentals, but you should. So let's look at this again. The ZB is up $1,094. The ZF is down $117. And this is on, by the way, this is on a ratioed basis. This is based on 1 ZB, 2 TNs, 2 ZNs, 3 ZFs, and 4 ZTs. So this is ratio. This isn't just, somebody might say, well, of course, because the tick value on the ZB is much higher. It's 4 times, isn't it? Well, they're right. They'd be right. But we ratioed this based on the, remember over here, the CME ratios. So I have the correct ratios here, and it's still expensive. This sucker's expensive. This sucker's cheap. It's only a matter of time until they're back together and back in equilibrium, just like here. Okay? When something gets too far out of balance, it's got to find its way back to the pack. That's just a natural order of interest rates. That's a natural order of the yield curve. All right? So what I did, what I want to show you over here is I said, okay, well, let's go ahead and act on that. So it's a 3-to-1 ratio. So we sold 3-to-1. It's 4. We shorted 4 ZBs. We're long 12 ZFs. And the other very attractive thing about trading bond spreads is span margins or spread margins. So even though you're trading 16 contracts, you're getting a big discount. So that's basically what we did here. We're selling what's expensive. We're buying what's cheap. They're going to come back into equilibrium. We don't know when, but when they do, we're going to take that money off the table. So I'm going to keep an eye on this and come back to it so that we can reference it and you can see for yourself how straightforward this is. Again, you're trading a spread. You are not faced with the demands of guessing direction or prognosticating direction. That's it for this one. On the next one, I'm going to cover curve fly, which I know you'll love if you are a bond trader or if you're any trader, because what you can do is see the relationship in the entire middle end of the curve You'll see. Stand by for that video. It's the curve fly video. You'll love this technique. The average risk to return is 4-to-1. You should not accept less than 3-to-1 on these trades, and they are very low risk because you're trading an instrument, the ZF, the 5-year, with only $7.8125. So it's 7.8125 risk per tick. If you are trading one of those prop firms, you're crazy not to look at this, in my opinion, because you can trade some size. Look at this. This was a $204 move on one. Okay, just on one. So that's it. We'll catch you on the update when we update you on this particular. This is the FOB spread. All right, fives against the bonds. We'll see you then.